Stop what you're doing right now. This is not just another market update. This is a warning signal flashing red across the global silver market. It is Tuesday, January 20th, 2026, and silver is trading at a staggering $93 per ounce in China, a price that's sending shockwaves through the entire commodity world. While Western markets stubbornly cling to paper prices stuck in the mid-80s, the real physical price of silver in China is exploding. This signals a brewing market detonation that could reshape the entire global silver landscape. And no, this isn't a small blip or some temporary spike. These are the early tremors of a massive shift, driven by a tidal wave of demand from 1.4 billion Chinese savers, industrial users, and speculators. They are all waking up to the hard truth that their currency is losing value and losing it fast. The disconnect between the physical silver price in China and the paper price in the West is growing dangerously wide, and the consequences will be felt worldwide. If you think the silver rally is over, you need to think again. The market is teetering on the brink of a violent breakout, and the window to position yourself before the real explosion happens is closing with every passing minute. This is your urgent wake-up call. The $93 silver price in China is just the beginning. To understand why this is happening, we need to look at what makes China's silver market so unique. It's a powerful blend of cultural traditions, retail investor behavior, and booming industrial demand. Grasping these characteristics is the key to seeing why silver trading at $93 in China signals a market on the verge of explosion. First, cultural demand plays a massive role. Silver has been deeply embedded in Chinese culture for thousands of years. It's valued not just as a store of wealth, but as a powerful symbol of prosperity and security. Unlike many Western investors who often view silver as a speculative asset or just another industrial commodity, countless Chinese households see silver as a tangible, trusted form of savings. It's a real, physical hedge against inflation and currency devaluation. This cultural affinity drives consistent retail buying, especially among middle-class families and older generations who prefer holding physical silver bars and coins over digital or paper assets. Retail buying in China is also incredibly organized and widespread. Unlike many Western markets where giant institutional investors dominate, China's silver market is powered by millions of small individual investors. They are actively purchasing physical silver through a network of local dealers, online platforms, and even informal community networks. This creates a broad and resilient base of demand that is far less sensitive to short-term price swings. When confidence in the currency starts to falter, these retail buyers flood the market, creating immense buying pressure that can easily overwhelm the available supply. Then, there's the industrial side of the equation. China is the world's largest consumer of silver for manufacturing, and it's not even close. The country absolutely dominates global production of solar panels, electronics, and electric vehicles. These are all industries that rely heavily on silver for its unmatched conductivity and antimicrobial properties. Just think about this. Solar panel manufacturing alone consumes hundreds of millions of ounces of silver annually. And this demand is only accelerating as China pushes aggressively toward its goals for renewable energy and technological innovation. This combination of deep cultural demand, massive retail participation, and exploding industrial use creates a perfect storm. When economic uncertainty rises, Chinese investors turn to silver as a safe haven. At the exact same time, factories and manufacturers are scrambling to secure the very same metal they need to keep their production lines running. This dual demand from both savers and industry makes China's silver market uniquely dynamic and an incredibly powerful driver of global price movements. So, in short, China's silver market isn't just a reflection of investment trends. It's a living, breathing ecosystem fueled by tradition, necessity, and sheer scale. And right now, it's about to push silver prices to astonishing new heights. One of the most striking and urgent features of the current market is the rapidly widening gap between the physical silver price in China and the paper silver price traded on futures exchanges like COMEX in New York. While silver is commanding around $93 an ounce in China's physical market, the paper price in Western markets stubbornly lingers in the mid-80s. This isn't just a minor anomaly, it's a glaring symptom of deep structural problems and market manipulation that threaten to upend the entire silver ecosystem. To understand this gap, we first need to distinguish between physical silver and paper silver. Physical silver is the real deal, actual metal in the form of bars, coins, and industrial-grade silver that you can hold, store, and have delivered. Paper silver, on the other hand, consists of futures contracts, ETFs, and other financial instruments. These represent claims on silver but don't necessarily correspond to actual physical metal held in a vault. The paper market is much larger in volume and more liquid, but it's also far more vulnerable to manipulation and dislocation from real-world supply and demand. So why the price gap? It's because physical silver in China is in an acute shortage. Chinese investors, industrial users, and speculators are aggressively buying up all the physical silver they can find to protect their wealth and secure supply, which naturally drives prices higher. Meanwhile, the paper market is heavily influenced by large financial institutions and banks that often engage in short selling, betting that silver prices will fall, and use complex trading algorithms to artificially suppress prices. This creates a bizarre situation where the paper price is kept artificially low, while the physical price reflects true scarcity. This huge difference should, in theory, create arbitrage opportunities. That's the practice of buying silver where it's cheaper and selling it where it's more expensive to profit from the price difference. However, in today's market, this is becoming almost impossible. Physical silver is scarce and incredibly expensive to move internationally. On top of that, regulatory barriers and capital controls in China severely limit the flow of metal across its borders. As a result, instead of closing, the arbitrage gap just keeps getting wider, further entrenching the price disconnect. Moreover, the market manipulation by large players involves suppressing silver prices through tactics like naked short selling and algorithmic trading specifically designed to cap rallies. These tactics completely distort price discovery, making the paper price a terribly poor indicator of the real market. The Chinese government, as recent moves to ban high-frequency trading algorithms on the Shanghai Futures Exchange, really underscore the severity of this manipulation and the panic it has caused among regulators. In essence, the growing gap between physical silver prices in China and paper prices globally is a giant red flag signaling a broken market. It reveals a fundamental mismatch between real-world supply and demand and the artificial constraints imposed by financial engineering. This disconnect is completely unsustainable. It points to an imminent price explosion as the scarcity of physical silver forces prices relentlessly upward, regardless of what the manipulated paper market shows. Have you ever wondered what happens when an entire nation's savings habits change overnight? Right now in China, a financial tsunami is building, and it's centered around one precious metal, silver. An astonishing $22 trillion, yes, trillion with a T, is sitting in Chinese household bank accounts. This wall of cash, the life savings of millions of families, is desperately seeking a safe haven. For decades, the path to wealth in China was simple. Work hard and invest in real estate. Property was seen as the ultimate asset, something that would only ever go up in value. But that dream has turned into a nightmare. The Chinese real estate market has collapsed. Developers are going bankrupt, construction projects are left unfinished, and property values are plummeting. The once unshakable belief in real estate as a store of value has been shattered. Suddenly, millions of savers are trapped. Their primary investment is crumbling, and the stock market feels far too volatile and risky. So, where do they turn? They're turning to silver. Unlike paper assets or bank deposits that earn next to nothing, silver is tangible. It's a physical asset you can hold in your hand, a store of value that can't be created out of thin air by a central bank. It has a long history as a trusted hedge against economic turmoil and inflation. The problem is the sheer urgency of this shift. That $22 trillion cash pile is stuck in a banking system offering interest rates below 1%. Meanwhile, the real cost of living is soaring, estimated to be rising at 10 to 15% annually. In simple terms, every day that money sits in the bank, it's losing value. This has triggered a panic-driven rush into silver. We're talking about everyone from taxi drivers to grandmothers, all trying to convert their life savings from paper currency into physical metal. This massive wave of retail buying is completely overwhelming supply chains and emptying out vaults. It's creating a feedback loop. The more people buy, the scarcer silver becomes, which drives prices and premiums even higher. To put this in perspective, the sheer size of this capital inflow from China dwarfs the entire world's annual silver production. Even a tiny fraction of that 22 trillion moving into silver is enough to cause unprecedented disruptions in the global market. This isn't just money sitting on the sidelines, it's a ticking time bomb, and it's poised to send silver prices to levels we've never seen before. Understanding this dynamic is absolutely essential for anyone watching the silver market today. As the silver frenzy in China intensifies, the government has tried to step in and cool things down. They've rolled out a series of regulations to control the explosive price surge and calm the market. But here's the twist. These measures have often had the exact opposite effect, making the situation even more chaotic and accelerating the physical silver shortage. One of the government's biggest moves was banning high-frequency trading algorithms on the Shanghai Futures Exchange. For a long time, these computer programs were the government's secret weapon for keeping prices in check. They provided liquidity and would automatically sell whenever prices started to rally too quickly. But as real physical demand from everyday people and industries exploded, the algorithms started to break. Instead of selling, they started buying, fueling the very price spikes they were designed to prevent. Seeing they'd lost control, regulators simply pulled the plug on these trading bots. The result? Liquidity vanished overnight. Without the algorithms there to absorb buy orders, even small purchases could cause prices to jump dramatically. What was once a controlled rally turned into an out-of-control wildfire. This move was basically an admission that the paper silver market in Shanghai was broken and no longer reflected reality. On top of banning the bots, the government also imposed strict position limits, slashing the maximum amount of silver traders could hold by more than half. The idea was to stop speculators from hoarding the metal, but this backfired spectacularly. Instead of calming people down, the limits sent a signal of pure panic. Market participants saw it as confirmation that there was a severe physical shortage. So what did they do? They rushed to buy even more, fearing they would be cut off from supply entirely. These actions also created a huge gap between the price of physical silver in Shanghai and the paper prices we see in Western markets like London and New York. With less silver available to trade and liquidity gone, the physical market became completely disconnected from the futures market. This just fueled more panic buying. In essence, the Chinese government's attempts to control the market have only exposed how fragile the whole system is. By trying to cap the price, they've accidentally confirmed the underlying scarcity, which has only pushed prices higher and made the physical supply crisis even worse. It proves a fundamental truth. When millions of people are desperate to buy a physical asset, no amount of market manipulation can hold back the tide. Now, let's talk about the other massive force driving this silver story: China's industrial sector. This isn't just about savers and investors. Manufacturers, especially in the solar energy industry, are putting immense pressure on an already strained supply. Silver is an absolutely critical component in photovoltaic solar panels. It's used as a conductor in solar cells, and there's no easy substitute. China dominates the global solar panel market, producing about 80% of the world's supply. The demand for silver from this one industry alone consumes hundreds of millions of ounces every single year. And here's the key. This industrial demand is inelastic. That's an economic term, meaning manufacturers can't just stop buying silver when the price goes up. They have production contracts to fulfill and government renewable energy targets to meet. They have to secure the silver, no matter the cost. This creates a relentless, underlying buying pressure that props up the price even when financial markets are shaky. And it's not just solar. Silver is vital for electronics, electric vehicles, and a whole range of high-tech industries where China is a global leader. These sectors depend on silver's unmatched conductivity and durability. As China continues to push for technological innovation and green energy, this industrial demand is only going to grow, but this surge in demand is colliding head-on with major supply problems. Global mining output has been flat for years due to declining ore quality, labor issues, and political instability in key silver-producing countries like Mexico and Peru. Recycling helps, but it can't come close to filling the widening gap between supply and demand. The result is a severe physical silver shortage that is hitting China's manufacturing hubs particularly hard. This imbalance has sent silver prices in China soaring. Manufacturers are being forced to pay huge premiums over the global paper price just to get their hands on the metal they desperately need. This rising cost of silver is becoming a major business expense, which in turn drives up the production costs and eventually the price you and I pay for solar panels and other electronic goods. To sum it up, China's industrial users are a powerful and unyielding force in the silver market. The urgent, non-negotiable need for physical silver is a primary driver behind the explosive price action and market tension we're witnessing. It's a perfect storm of financial panic and industrial necessity, all converging on one precious metal. Thanks for watching, and be sure to follow for more insights into the forces shaping our global economy. Have you been watching the silver market? Because what's happening right now, especially in China, is a massive warning sign that most people are completely missing. We could be on the verge of a historic price explosion, and if you're not paying attention, you might get left behind. Let's break it down. Right now, there's a massive surge in physical silver demand coming out of China. We're talking about a wave of money from Chinese savers, combined with huge industrial users, all creating a supply crunch that's about to shake the entire global market. One of the most critical signals is what's called the Shanghai premium. This is the price difference between physical silver in China and the paper price you see quoted globally. Recently, this premium has widened dramatically, reaching double-digit dollar amounts per ounce. When you see a gap like that, it's a giant red flag. It tells you there's a serious physical shortage and intense local demand. This isn't just speculation, it's a real supply and demand crisis, and it often comes right before a sharp, sudden price increase. Why is this happening? Chinese households are moving a portion of their staggering $22 trillion in savings into physical silver to protect their wealth. At the same time, industrial demand, especially from solar panel manufacturers, is relentless. China's own government and industrial buyers are securing long-term supplies, which isn't just a short-term blip. It's a permanent structural change in global silver demand. For international investors, ignoring what's happening in China is like ignoring a hurricane warning. The Chinese market is the canary in the coal mine for silver. When physical prices there soar far above the paper prices we see, it reveals a fundamental imbalance. The global market will be forced to catch up. Relying on outdated paper prices that don't reflect real-world scarcity is a dangerous game. Now let's look at another powerful indicator, the gold to silver ratio. This simply measures how many ounces of silver it takes to buy 1 ounce of gold. For thousands of years, this ratio has averaged somewhere between 15 to 1 and 30 to 1. Today, it's sitting near 52 to 1. This shows just how undervalued silver is compared to gold. If that ratio simply returns to a conservative 25 to 1, with gold holding steady, silver's price would have to jump to around $188 per ounce. If gold climbs higher and the ratio tightens even more, we could easily see silver at $250 or more. The technical charts are screaming the same thing. Silver has recently smashed through key resistance levels on heavy volume, which signals powerful bullish momentum. The moving averages are pointing up, and indicators like the Relative Strength Index show that buying pressure is growing stronger every day. This isn't a short-term spike. All signs point to a sustained rally. So what does all this mean for you? The message is crystal clear. The urgency is real. Waiting for a small dip or a discount could mean missing the boat entirely. As premiums soar and physical silver becomes harder to find, those who hesitate will be watching from the sidelines. The disconnect between the physical reality in China and the paper prices elsewhere can't last. A major price correction is coming. This isn't just an interesting market development. It could be one of the most significant investment opportunities of this decade. Don't be the investor who gets blindsided. Pay attention to these signals, do your own research, and consider how you can position yourself before this market fully erupts. Thanks for watching. If you found this breakdown helpful, make sure to like and subscribe for more insights. See you in the next video.